Hey guys, Mike Malarzik, New Fed Mortgage. So our good buddy Jerome Powell and the Feds have once again raised short-term interest rates another 75 basis points. So that makes this the fourth consecutive time that they have raised the federal fund rates by 75 points. So what I wanted to talk about today is how that impacts you as a consumer, how I see the mortgage and real estate markets progressing into 2023, and explain why I think it's really crucial that you have a plan moving into next year. So, look, I'm not going to sugarcoat it. I mean, it sucks right now. It's a big pile of poo. Everybody is feeling it, and everybody has been impacted in some way, shape, or form by inflation. So, whether you're a consumer, a business owner, whatever, we're all feeling it. We're all being impacted. And I just want to be clear here. So, when the Fed raises rates, number one, that does not mean that your mortgage rate automatically goes up. You're locked into that loan unless you have an ARM or a variable rate mortgage. That won't change. And number two is when the Fed raises interest rates, that does not directly impact mortgage interest rates. Okay, that is more of a function of the stock and bond markets reacting to the Fed's decision to raise interest rates. Okay, so what this does mean though is that interest rates on short-term consumer debt are increasing. So the cost of credit, the cost of borrowing money has gone up. So that's the interest you're paying on your credit cards. If you have an equity line or a home equity line, those are all being impacted every time the Fed raises interest rates. So let's take a look at that and see how those payments are impacting you now. So here in this slide, we're looking at in March of 2020, prime rate on an equity line was 3.25%. Okay, and as you can see, it remained relatively unchanged all the way into March of 2022, where it was at 3.5%. Now, as you can see, as all these Fed rate hikes happened over the past several months, prime rate today is about 7%. It may be even a little bit higher depending on your financial situation. And as we go into this next slide here, I want to show you what that does to your payments here. Okay, so right here, let's say this is for a home equity line of $60,000. Okay, at the beginning of the year, your interest rate was 3.5%, and your interest-only payment was $175 a month. Now, as a result of all these rate increases, in that short period of time, your rate has doubled all the way up to 7%, right? So you're looking at a payment of $350 a month. And that doesn't look like it's going to change anytime soon. So I wanted to use this example to really emphasize why I feel it's absolutely critical to look at your situation and come up with a plan as we move into 2023 so that you don't end up in the weeds and underwater. And I really think that there's just two plans here. There's a plan A, which is kind of do nothing and wait it out, and plan B, which is how are we going to recession-proof your family and make sure you're financially secure as we roll into 2023. Okay, so let's take a look at these two plans. There's a plan A and a plan B. Okay, so plan A is for the family that they don't have any credit card debt, they haven't tapped into their home equity line, they have an emergency fund, they've got reserves in the bank, and their jobs are set. They're pretty much recession-proof, right? So there's really not a lot that this family needs to do to weather a storm as you roll into 2023. So plan B is the one that I really want to focus on. So this is a family, that's struggling, like a lot of us are, struggling to make ends meet. They've run up some credit card debt. Maybe they've tapped into a home equity line to kind of make ends meet. They don't have any emergency fund or reserves in the bank. Obviously, they're tapping into their credit cards and equity lines. And they may potentially be in a job that could be at risk during a recession. And that's a significant concern here. So plan B is the one I really want to focus on. Okay, so step one of plan B is what we're looking to do is we want to get rid of all your debt now, right? We want to refinance you, pull some equity out of the house, we want to pay off those credit cards, pay off that home equity line. get you in a position so that if bad things happen into 2023, you're going to be okay. All right. Now, when you do a cash out refi, it requires a significant amount of equity to be left behind, a minimum of 20%, right? So if things go really south, and believe, I'm not trying to be Chicken Little and say the sky is falling or whatever, but I want to be real here. If the value of your home drops, your equity ratio is also going to drop, and you might not have enough for that 20% reserves that you need to leave. Okay, so here we are, step 2, plan B. And the goal of this step is to refinance you in 2023, get you into a better rate. Okay, so we've done the cash out, we've eliminated all your debt, and as a result of that, you're going to have a much higher FICO score. And I've mentioned this in some of my past videos. Historical data has always shown that mortgage rates come back down after a recession. And most industry leaders and insiders believe that rates will come back down to earth at some point in 2023. And because we've done all the heavy lifting in step 1, we're now in a prime position to take advantage of decreasing rates with a rate and term refi, which is much cheaper than a cash out refi and requires a heck of a lot less equity. Okay, so we've set ourselves up to make a move into 2023. When that opportunity presents itself, we're going to jump all over it. So I've also included some additional videos here where I go into the exact details of what Plan B looks like, both step 1 and step 2, and what needs to happen so we can protect you and your family going into 2023. So as the saying goes, pray for the best, plan for the worst. You know, and I want to be that guy that helps you make that plan so we can protect you and your family as we all continue to slog through these murky waters rolling into 2023, right? So listen, Mike Malarczyk, New Fed Mortgage, I would love to help you. Please reach out to me with any questions, concerns, anything. Advice is always free, and I would love to help you. Thanks and take care.